And so private lenders generally, like I mentioned, they just kind of do it by accident. Then they get bit by that private lending bug. Next thing you know, what was supposed to be a passive source of income, now they're thinking, well, I want to make this an active source of business income too.
Welcome to the Dynamist podcast, where we are all about unlocking a fruitful life, removing your limiting beliefs, and getting to the next level. My name is Tim Garul, and I'm stoked to grow on this journey with you. As David Geffen says, we are each the figment of our own imagination, and some people have the greater ability to imagine than others. Welcome into this week's episode of the Dynamist podcast. Selfishly, I'm very excited for the guest that we have in here today. She's just a rock star. You just meet certain people and they just knock you out of your socks the first time you meet them or hear them speak. And the guest we have today is one of those. She's incredibly intelligent, incredibly articulate. She's a go-getter, hard worker. She's so approachable. She communicates so well. And man, I'm really beside myself that I got her to come sit down and do an interview with us. I think you're going to get a ton of value. I know I'm about to get a ton of value for what Beth is going to bring to us today. So our guest today is Beth Johnson, and Beth is the co-owner and managing partner of Flynn Family Lending, a private money lender. Beth is one of the co-authors of Lend to Live, the book on how to earn hassle-free passive income in real estate with private money lending. That was a book produced by the Bigger Pockets Publishing, and it's about earning hassle-free passive income in real estate with private money lending, with a mission to help others invest in private money loans for predictable and passive income through education and a private debt fund offering. Beth and her husband and business partner, Matt Flynn, are dedicated to educating new and aspiring private money lenders on how to fund a private money loan safely and securely as an alternative investment vehicle. They also focused on building a community for small and independent private lending originators and fund managers, including both passive investors and active business owners, for the purpose of community building, best practice sharing, and curated learning opportunities specific to challenges faced by small business owners. She also offers small group coaching for new and aspiring private money lenders that blends on-demand web-based content with practical application of the core concepts learned in her book. That's a mouthful. Beth, your resume is quite packed. Welcome to the Dynamist podcast.
Thank you so much. I'm really excited to be here. What a kind and generous introduction. I appreciate it.
It's all true. It's definitely all true. You know, the podcast is at this, really unique size where I get to really carefully curate the guests that we have on here. And the guests that I pick, I have in mind for a long time. And there's really specific reasons of why I want to bring them in. And you're just one of those people on the list that just, number one, you're a doer. I just love your work ethic. You're so well-spoken. And it's not baloney. That intro I gave you is really true. Every time we're together, I'm just continuously blown away by your presence and your depth of knowledge. And so selfishly, how could I not want to chase you down and arm wrestle you into a private conversation for 45 minutes?
Well, I very much appreciate it.
You're very welcome. So we just had you at our Pints and Properties meetup. You were the keynote speaker. And I got to say, you brought such good energy. We had a crowd follow you there. We had people drive from a couple hours away just to come and listen to you speak. And it was such a great keynote presentation. I read your book, Lend to Live. It was so helpful. It's been incredibly helpful in my private lending journey, just learning how to put safeguards in place. And you have recently invited me to your online community, the Lend to Live community. And every day I'm on that chat, there's just so much value on that thread. I'm continuously blown away about the value that I'm receiving, that people are giving, the advice that you're giving in that thread. And yeah, I'm just stoked to have you here. And I think what we're going to do is we're going to talk a little bit about private lending first. We'll talk about your journey. And then I'd really like to get tactical on the back end. If this is something that you are interested in doing, wanting to become a private lender, what does the progression of that look like? And so really quickly, and I'd love to have you chime in here in just one sec, private lending for me just makes so much logical sense in the landscape, in the scope, especially in the market cycle we're in right now. We're living in the post Bigger Pockets era where everybody and their brother has heard of Bigger Pockets and Brandon Turner and David Green, and they've all read the books and they, listen to the podcast, and it's extremely competitive. And the market out there is just a little bit different than it used to be. The landscape's different. it seems like there's not as much meat on the bone, and everybody's fighting over these flips and these burrs and these rehabs and these wholesales for, not much cash flow on the backside, especially in the interest rate environment today. And when I read your book and when I listened to you speak and talk about, just where you see the market going and the advantage of being the bank essentially in helping business owners get their business going with funding and securing it in a safe and secure manner where there's, income coming in continuously and it's secured on a hard asset. It just, for me, it made so much logical sense to look into private lending. And you've been a huge inspiration on my journey. I'd love for you to speak into why you think private lending right now is really an interesting space that people should be looking into.
Well, I'm really glad that the book and my story has inspired you. That was what I had hoped to do when publishing it. I just think that private lending is something that's really not often talked about. To your point, in Bigger Pockets and other real estate forums, they talk about flipping, burring, buy and hold investing in, storage, all of these really hot topics. But private lending is kind of in that background and nobody really speaks to it. And yet it can be a very safe and passive source of income for those who might not prefer to do some of the more active investing out there. And so I really want to make sure that others know about it because there's two sides to every transaction, those that borrow and those that lend. And so it's better for active investors out there the more private lenders get involved and have their capital and learn how to actually be the bank so that they can get some more deals done without having to rely on banks or institutional capital. So that was the whole goal behind it.
Yeah. Yeah. And man, just the work you've done in this space is just to make other people, see it as more approachable has just been incredible. Can you just take us really quickly, and I don't want to stay here too long because we have so much ground to cover, but can you take us back to the beginning of how did you even, you've told this story a million times, but how did private money even come into your arena? Like, how did you become aware of it and what made you start?
Well, as if you heard me on other podcasts, you'll hear that it was really randomly on a date. So my now husband had brought it up. I'd been in real estate investing before. I grew up around it with my family, kind of raising me in that culture, much like you had been part of as well with your blended family. And it just took me by surprise and was a happy accident. And I think that if you talk with a lot of other private lenders, they'll tell you the same thing. It was never that they just set out on that journey. It was just that it was either a natural progression from active investing to buy and hold investing. And then they say, well, I have enough properties. Now what? And then they want to safely lend out their capital because they understand real estate. Or you're just like me, just very organically having conversations with somebody about it. And you're like, wow, that makes a lot of sense. And I could do that easily with 2 kids and a day job. And I wouldn't have to put forth so much effort and deal with a whole lot of babysitting of general contractors or tenants. And so there is just this natural progression, just like that I went through, and very much by chance. And so when I heard about private lending, I decided I would just help my now husband get involved in it. And the more I learned about it, the more, this thing just kind of took rapid route with me very quickly, because you go into a room and say, I have money to lend out, and everybody pays attention. And so I had to learn very quickly how to do it well, how to secure it, and how to do it for other people too. And so private lenders generally, like I mentioned, they just kind of do it by accident. Then they get bit by that private lending bug. Next thing you know, what was supposed to be a passive source of income, now they're thinking, well, I want to make this an active source of business income too. And so it's just kind of this natural progression, but it's never, for a whole lot of people, it's not by design.
Yeah. Yeah. And what is passive income in real estate? I mean, that's a myth. There's no such thing, really. There's no such thing. It's always work. I'm curious, when you started lending, when you did that first deal, you met your husband, he had mentioned that he was interested in lending again, it sparked your curiosity and you started on this journey. Did you have any experience in real estate up to that point? Did you own rental properties? What was that incipiency before you really started lending your own money out?
I did. I bought my first house in the early 2000s. It was a live-in flip, just cosmetic. And I was at a point in time right before the Great Recession where I could do minimal, stay in it for two years and a couple of weeks or a couple of months, and then, cash out a very handsome return on it, capital gains free. And so I started doing some live-in flips with my ex-husband. We had several under our belt when 2008 rolled around. We were lucky enough to get out of that unscathed, lost a little bit in potential income, but didn't lose any of our principal. And at the time, I was taking out private loans for my parents. So I was actively involved in their real estate journey growing up. I hung out at their flip projects. I hung out at the rentals. Had to pick up shingles and nails and sweep rooms. That's how they kept us busy and sort of brought us along in the journey. And so I did have some experience, but I didn't really truly understand the capital side, because what I didn't understand was my first loans from my parents were truly private money loans. And now I do.
So that's a great segue. And let's get a little bit more tactical here because, I get this question all the time when people are calling me and asking me about private money versus hard money. What's the difference? What's the main difference in the landscape and the advantages to using private versus hard, et cetera?
Well, you get a lot of different definitions from a lot of different people, depending on who you talk to. I would say, in a nutshell, the way I would define the difference between hard money and private money is the source of capital. There are truly private individuals like yourself and me who lend out our capital. We're sort of like a speakeasy. We're kind of hard to come by. They're kept secret because nobody wants to share, much like, a babysitter that you want to have on date night. You just don't tell your girlfriends. And so truly private, high net worth individuals that are private money lenders is the more traditional sense. Whereas I would say hard money is generally a brick and mortar storefront. They have a retail side of things, not a retail, so to speak, but they've got like an office and they have a marketing presence and a brand recognition. They may be funding deals at the auction steps. There are multiple flavors of hard money, and it's kind of hard to figure out what private money truly is because the industry itself is rebranding away from hard money and the negative connotations to more of a private money lending brand. Now, in the hard money space, there's basically three different flavors. There's national hard money lenders that offer really discounted rates and have institutional investors that are backing up their loans. But they lend all over the country, right? So it's just a few steps below conventional lending, more asset based, but they still care about your experience. They still care about the asset itself, but they may run credit. They may run income verification. Then there is, your regional hard money lenders. Those also provide, some, at the time back in the day when hard money was cheap, it was kind of in the upper mid single digits. And they may have a couple of offices, right? They may do, the Pacific Northwest or the West Coast. They don't do it nationally, but they have maybe a regional office within a loan committee that approves your loan. And so you're not really working with somebody who's a key decision maker in that sense. But when you go to true local hard money, those are the ones that are auction funding, and they have maybe one single office and they're hyper local in your market, can run things very quickly, can do in-house valuations, and maybe don't require a BPO or a full-blown appraisal for you, but they're going to cost a little bit more.
Yeah. And I've also heard you say, hard money lenders typically have access to like warehouse credit lines where they can leverage larger amounts of credit to where it's not their personal money per se, or raised funds from the community, but, bank's money on a leveraged credit line or something like that. Is that accurate?
Yeah. Well, they do take in, private capital from high net worth individuals that want to maybe invest in their private debt fund, which is essentially a pooled mortgage fund to be able to provide large loans out with a pooled amount of capital. But then they do go and pledge those assets, those loans within that portfolio in that syndicated private debt fund to a bank or an institutional investor and they pledge that as collateral, and then they receive an additional line of credit on top of that. So it allows them to increase their level of origination and funding, but it provides a slightly higher level of risk for those passive investors involved in that fund.
Right. And I know it's going to be really hard to paint with a broad brush here, and I apologize for putting you in this position. But, hard money, they have somewhat, it's all across the board, but also LTVs, like loan to value limits, cash down, that type of stuff. Interest rates, are they similar, or are they very different than like on the private money landscape? And we'll caveat this with private money can be whatever you want it to be. If you're the bank and you're lending out money out of your bank account, like you set the terms, but there are like market, there's market demand for private. There's like, typically interest minimums or ceilings and floors and origination points. Would you agree with that?
Yeah, I mean, I think one of the two things that a borrower really needs to factor in is core capabilities and cost. So, with the hard money, they have, first off, extraordinary amounts of capital that most truly private lenders don't have. And so you have a capacity with hard money that generally a lot of borrowers really need access to, especially volume flippers, large commercial deals. It's not like you can just go to your neighbor or talk to a colleague and get $1 million loan for them. So there's a capability that hard money lenders have. And then between local and maybe national lenders, back in the day when cost of capital was super low, right? You could get a conventional loan for 2.5%, 3%. The difference between a national hard money lender and a local was pretty wide, especially if you were an experienced flipper or buy and hold investor. What you could get with the mid single digit rates, you might require an appraisal, might require some significant experience, but it was available. And then conversely, you have local hard money lenders. I'll just take, the Seattle market since that's where we're at right now. And that was generally in the 11 to 12%, but they could act really quickly. They were at the auction steps, like I mentioned. They can order title quickly. They can close with an in-house valuation. So they're not really reliant on a third-party approval from your institutionally backed investor. You don't have to take it to a loan committee that's in a different state. They can make decisions in that office and very quickly. With private lenders, the core capabilities might be a little bit more limited, just generally based on how much capital you have available. But to your point, it really runs the gamut. You might have, a nice, sweet, older couple that is really, on the sunset and retiring and want to give a younger investor a break. And so they may offer their private loans at 6% and no points. But if you work with a private lender broker like myself, where we kind of aggregate capital and provide private lending out, we're going to charge some points and some higher interest rates, but we also have a lot more capacity to be able to fund deals at higher amounts too. So there's a trade-off that one has to manage between hard money and private lending. And actually, the reality is most investors need both.
Yeah. And I was just like doing some perusing on websites of hard money, and I was on your website the other day, and I was just doing like a high level 10,000 foot view. Now every scenario is different. Each borrower situation is different, but I was seeing on these hard money sites that, some of them were offering like 85% LTV. I saw one hard money advertising 90%. And, it's crazy. And I was looking at your website, and you can do a lot of things that these hard money lenders have, caveats that they cannot do. Like, for example, second lien positions and cross collateralized, funding. And you could do 0% down on your website if there's enough liquidity or equity in this deal. And so it's really cool because it highlights the versatility that private money has in these scenarios. And you had mentioned that, look, it's not Walmart, it's Nordstrom. It's a very specialized boutique product, but that product has a necessary place in the marketplace. And I think that, the investors that have an education who are operating on a higher level, they understand that, and they're willing to come and work with a company like yours, for example, who provides the service you provide, because the cost is a benefit to them on the back end when they're doing these transactions consistently. And, we both are on social media, and there's a lot of larger names in our marketplace who are consistently using Flynn Family Lending, and they're using it for specific purposes. And that's because you guys execute, you have the capabilities to get the deal done, you understand the markets. And so, yeah, it's just interesting when you're looking because, until I really started getting into private money more, I used to just call it hard money. I lumped it all into one category. And it's, as you start wading in deeper and deeper into the pool, you realize like, oh, there really are two different things, and you need to understand them and how to use each of them appropriately.
Absolutely. I mean, I think it all falls under the umbrella of asset-based lending. And again, depending on your loan scenario, your project, you're going to need both at various points in time. We do offer creative financing from a pure marketing positioning standpoint. As you're building up your business, I once read a book where it said, you don't want to, it's much harder to find a parking spot when trying to take somebody else's. Find an open space and park there. So for us, we wanted to put ourselves out there, the creative financing solution for active investors by doing things that other lenders couldn't do. And so by going out and leading out with creative financing like junior lien position, cross collateralizations, that's the talk track that no other hard money lender can really talk to or speak to or market. And so it was very easy for us to build up our brand and our recognition, over the past 9 or 10 years. Now people choose to stay with us because they realize the ease of doing business and how quickly they can get deals funded, and how easy we are to work with. But that doesn't mean that people don't need hard money. At the end of the day, if you need really high leverage, we're not that person for you. Yes, we can fund 100% loan to purchase price. But again, we're using things like additional rentals as a cross collateralization. We're using walk-in equity from significantly discounted off-market deals to help supplement your, normal down payment requirements or rehab costs. Other hard money lenders that can go higher leverage operate at a much larger scale than Flynn Family Lending. And so they can take on that higher risk. They have the means and ability to do so. They might have in-house counsel to help them and a lot more deeper experience to take on those deals and that risk tolerance. We just aren't that way. We truly bring in private capital, and we need to safeguard it the best we possibly can.
That's exactly it. Is you have an obligation to safeguard it, right? Like if I gave you my hard-earned money that took me 2 years or 3 years or a lifetime of employment to, build up, and I give it to you, like, man, I really hope you at least return that money back, and preferably with a return. And so if you're doing crazy things that aren't secured appropriately, well, that's being a little bit irresponsible. So I really appreciate that model that is forward with Flynn Family Lending, and that money placed is secured and it's a safe bet overall. So I want to talk about how you progress from, okay, so you got in the game, you started lending, you were lending your own money. First of all, what was that first deal? You placed ads in the classifieds, right? In the newspaper?
When I agreed to help my husband restart his private lending practice, he employed an ad, a very simple ad in the classified section of the Seattle Times that said, my family has money to lend, credit income, no problem, and had his name and his phone number. And I'll tell you, it was highly successful and the conversion rate was really strong. And there was a, pretty big following of boomers who still read the classified ads on a daily, weekly basis. They were on fixed income, maybe had a portfolio of rentals, and couldn't go out and get an actual loan from a conventional source. Matt, my husband, Matt, had actually worked in conventional lending for close to a decade. And so he was seeing a lot of these people get declined post Great Recession, but still had a lot of great collateral, a lot of great the 5 C's of credit, if you will. They covered off on most of those, but there was this one thing that might prevent them from getting across the finish line. And so he really wanted to get started again. And that was where I decided I would help step in with him.
So how much money did you guys get started with?
For myself, I was just, post-divorce, to be quite frank. Matt was actually my first date. He was my only date post-divorce. Wasn't supposed to be that way. We joke, it was never supposed to be a relationship, let alone a business. So I was just moving over and resettling, bought my first, my new house on my own with my kids, and had decided to roll over a legacy self-directed IRA and lend that out. I didn't really know much about the stock market and thought that this might be a safer, easier way for me to lend out. Matt had a small amount of savings, and then we had 2 investors that worked with us as well. One was a school dad friend, and one was a golf buddy. And so we didn't, in total, I think between all of us had maybe just $1 million or so when we first started out. And my first loan was actually I think it was around $65,000, $70,000 in second lien position on a recreational marijuana grow facility in Seattle, since it's legal here. And so that was my first foray into private lending.
Yeah, and that's a whole topic that I am scared to even get into yet, just because commercial is a whole other game. There's a whole other list of checklists I'm sure that I'm going to need. But so I'm curious, you pulled 4 people together, yourself, Matt, your husband, and 2 other friends and investors. What kind of where was this money sitting? Did you guys put it in some sort of LLC? Was it in a fund? How did you pull the capital? And then when you place the loans, was it you personally lending your money to specific deals, or was it more of like the entity that was lending out the pooled capital and you guys were sharing in the interest in the placement of that capital?
Great question. So we actually didn't pool our capital together. I think it was really important for us early on that we allowed capital investors, those that wanted to act as the lender on our behalf, placed their capital and were actually named on the lending documents themselves. So those security instruments, they were placed on there as the named lender or the holder of the note, the grantee on this deed of trust. And that way they had ultimate security and control over it. When you pull capital, it actually is considered a security in Washington state. And so we wanted to make sure that we could avoid some of those circumstances that would deem our business as security or subject us to securities laws and regulations. And so utilizing what we would call a whole note approach meant that as Flynn Family Lending was meant as the broker of record. So we actually brokered the relationship between the borrower and the lender. And then so we received the points and we passed through the interest to the lender. So one of the two friends of ours, or it was us directly. So we didn't want to fractionalize loans, meaning pool my capital with our friend Mike's. We let Mike be the sole lender of record on there so that he had full autonomy and control over every aspect of that loan.
Okay, got it. So you guys weren't lending out of like an entity, you were lending in your personal name at that point, and you were brokering it. Since you were finding the deals, you were acting as the broker, you were taking the origination points, and then whoever's loan it was, whoever's capital it was, they were earning the simple interest. Is that the gist, essentially?
Right. Flynn Family Lending, for all intents and purposes, at the time when we started, was considered, I call it a private money matchmaker. I don't really like utilizing the term broker because I think that sometimes that means that the broker is more focused just solely on the origination. And when that deal is funded, they tend to just walk away and not really care. We truly care about the entire loan life cycle. We want to help you find the right deal. We want to curate the right loan opportunities to present to our capital investors. And then once it's funded, we will see that all the way through with you every step of the way until that principal capital investment is returned to you. And so, yes, we acted as the money matchmaker. But when I did my own loan on that marijuana facility, my self-directed IRA was the actual lender itself.
Got it. Okay. Yeah. And that makes a lot of sense. And this is where it gets a little weird, is that there's not a ton of regulation in private lending. And so, if you're a conventional mortgage lender, for example, you need a license, or, a hard money lender in certain states, you need licenses, but it's kind of this weird gray area with private lending where, you could be matchmaking and not having to be officially licensed. Right? That's kind of, it's ambiguous, right?
Yeah, it's true for the most part. I mean, there's a handful of states that do have some licensing and regulatory constraints associated with private lending. Up and down the West Coast, you'll see it. Oregon, Washington is not. You don't need to be licensed if you're just lending out your own money. But in Oregon, Idaho, Arizona, California, the Dakotas, even Virginia and Florida have a few weird tweaks for their private lending regulatory constraints. But by far and large, in most states, you do not need to be licensed to be a private money lender. That's true.
Now, with private money, if you guys were raising capital, let's get technical a little bit. Could you raise money across state lines? So I'm sorry, maybe raising money at this point in time in your journey is the inappropriate term, but let's say your partner, Mike, lived in, Idaho, for example. Could you use his money even though he lived in Idaho as a private lender?
In most cases, yes. So like I do have lenders that lend us their capital or had done loans with us in the state of California, for example. And through my securities attorney, we wanted to get some clearance and make sure that she was okay to lend out. And so long as the collateral was in Washington state, then she didn't need to be licensed. So in many cases, it depends on where the collateral is. Yes.
Okay. That makes a lot of sense. And then as far as like where you can lend, does that have to be in Washington state, or can it cross state lines?
It can cross state lines. There is some issues with knowing where you're lending, where you are, where the borrower is, and where the property is. So there's definitely some considerations about lender, home state. I'll call it the borrower's home state, or where they reside and where the property is. And in some cases, that can be 3 different states. And so you really need to make sure that you understand the regulations and any licensure or usury law associated with each one of those states. So I would always put out there that you definitely need to find an attorney that not just practices in real estate, but actually delves in private lending on a regular basis as part of their law practice, so that they can educate you on which state is going to take preference if there's an issue to arise, what kind of foreclosure or default issues are you going to encounter depending on what state you're in? Do you need to be licensed or be foreign registered in a different state? There's so many different things that need to be covered. And so when you're dealing with multiple states, you really need to have conversations probably with multiple attorneys before you get started. And that's where passive but not so passive thing comes in that you were saying before, right? There's a little bit of legwork that you have to do up front.
Yeah. So, the first private loan that I did was pooled capital. We fractionalized the note. We pooled capital. Everybody brought in capital that they lived in different states. And I talked to a number of attorneys about doing this post, right? Everything was fine. The deal was successful, went full cycle. But, when I talked to attorneys, I have like half of the attorneys say, well, you couldn't do that. It's like an SEC violation, securities violation. But the other half said, well, who did you pool the capital from? If it was like very close, family and friends, and it was like 1 or 2 deals a year, like that's fine. It's allowable because it's like in your personal network. And it's just this very murky. So whatever you do and whoever you choose to use, just make sure that attorney's with you for the ride. That's like, willing to go on the ride with you, and it's all above board. But, I didn't think about that when I fractionalized that note and pooled capital together when we first did this loan.
Well, I would say that the counsel from my attorney in Washington State is that if the lenders know each other, pooling that capital, whether it's under an entity or whether it's just you individually, because it can be done that way, right? It's not considered a security in Washington State. If I were to pool capital within a fund, a private debt fund, for the purposes of lending it out, yes, then I am considered a security. And if I fractionalize 2 people who don't know each other, so if I was going to fractionalize you, Tim, with my cousin, and you don't know her, then that potentially could subject me to securities law enforcement in Washington. But there are other states that may consider any fractionalized loan, whether you know each other or not, a security. And that's what's important to know. And then I would just say that on top of that, you don't have to necessarily do it in an entity. So that might be the advice, that some attorneys are saying, is that when you guys create an LLC and you all put your capital in there, yeah, it definitely could smell, look, and feel like a private debt fund, right? But if you were to go on 50%, Tim Gruhl and Beth Johnson, 50% as the lenders of this loan individually on there, right, married as our separate estates, then that would not necessarily be an issue because we are both named on there. We both know each other. And so there are different ways to play around that. I think it's when you create the entity and you start putting capital in, particularly from people who you don't know, and you're raising capital, then that can raise a lot more legal yellow flags, I should say.
And I know that's kind of where you are in the journey right now. And I want to cover that, but I kind of want to get there in a specific progression, because I want to build the story mostly from my understanding, selfishly. That's, the benefit of having the podcast. So you're placing capital, you guys are lending, and lo and behold, what happens to property values is they start to incrementally creep up. And before you know it, the pool of capital that you guys have been lending is, not sufficient to keep up with deal flow. And I'm imagining that you run out of money at some point. Is that true?
Well, yes and no. I'm never running out of money, so to speak, but there's some constraints, for sure, because especially let's take my old business model for, when I was private money matchmaking, because I only did whole note or whole trust deed investment. There's 2 different types in a state. States can be mortgage states or they can be trust deed states. There's a few that maybe are both. We're a trust deed state. And so when I do whole trust deeds, I'm placing a loan for Tim, with another lender only a single lender, right? You're the borrower. And in that model, then if my lender only has 400 and you need 500 for a deal, then I have to figure out another lender that can potentially go. If I have no lenders with a 500,000 and three of them with only 400, and I'll say only in quotes because that's a lot of money, then it makes it difficult for me to manage. And so naturally over time, we kept growing organically. People heard word of mouth that they wanted to lend money out through us. In our model, because it's not a security, you don't need to be an accredited investor to be a whole note investor. So that was attracting a lot of, upper middle class families who had a small amount of savings that they wanted to lend out, but were too busy to actually do any sort of active investing. So we amassed a collection of around, 65, 75 capital investors that lent money through us. But to your point, with double digit appreciation in the Seattle market, that loan size just kept creeping up and up and up. So when we first started, our average loan size was around 75 to 125,000 because we did a lot of seconds. That was enough for a down payment and rehab costs. Now, all of a sudden, with the way that the prices are in this region, that doesn't really get you across the finish line. So our average deal size now is about 450 to 500,000 on average, which makes it very cumbersome and difficult for us to place whole note investors in.
Yeah. And so that was my question is at what point in this journey did you realize okay, we have to start, and I don't want to call it raising capital. I think that's, my terminology is all wrong for this podcast. I don't know the correct terminology, but really people, you weren't raising capital, but by word of mouth, people were like, I also want to participate in this. And you were in a position to where you guys needed more capital because you had deal flow that needed to get filled. And so it was a symbiotic relationship. How soon into the journey did that start happening where you kind of needed that word of mouth for these people with cash to come in and start helping, be additional lenders to fund these deals?
Well, you're kind of teasing out, the whole constraint of starting out as a private money lender in a passive situation and then really growing it into a full-blown business, right? We were fortunate enough that we had a lot of interest very organically, that we never had to go out and raise capital or go and promote our services. It just came to us. And if that money came to us, then we had enough deal flow, with the reputation that Flynn Family Lending had in this region and occupying a marketing positioning that nobody else could offer. I always had a place to find a loan that would match my capital investors' needs. And so as our investor capital grew, then I could take on more deals and vice versa. So we went from like $1 million all the way up to, I think, by the time we transferred over into a private debt fund, we had about it's hard to say really, about 40 to 50 million in under management. And I say that loosely just because when you're in whole notes, when they come back and that capital returns, they're not contractually or morally obligated to lend through us again. We earn their business through trust, and we don't require them to sign a contract. And so they would continually lend out. Some would have higher amounts of capital or unlimited. So, but it got to that point where about 40, 50 million under management, we really had to change the way that we did business. But we took all of it in very naturally. And if I didn't have a place to fund it, then I would just maybe broker it out to another hard money lender if it was in first position. And I had a way to still source a deal. So I never was turning people away, not necessarily, but we're always looking at deals and our conversion rate's really low. We're turning down more deals than we're saying yes to. And so I never had that need to really go out and raise more capital because I just wanted to be comfortable with what came to us. I wasn't going to go out and hard sell people on our product.
Yeah, that you just brought up an interesting point. I'm assuming for the deal flow, for you, like finding the deal flow, were you just going to meetups and, essentially like what you said, hey, we have money to lend out. And then, these investors were just putting you in their phone book and telling their friends. Is that how you were finding deal flow, or were you doing other things as well?
Well, it started out with that classified ad, as I mentioned. And then we did a little bit back in the day in Craigslist. But I would say that the biggest way for us to really get out that messaging was to join value add social media platforms like the Washington Real Estate Investing or WARI group on Facebook, and not really overtly market what we do, but really just add value. hey, here's how we would approach this deal and the financing. Here's some key considerations that you need to take a look at when you're, pitching your deal to a private lender or hard money lender. And just through that value add posting and commenting, we really created a really strong following of investors who wanted to listen to what we had to say and wanted to hear more about our offering. And then it was just word of mouth. I mean, our cost of acquisition has been excruciatingly low just because we're providing some value and a commentary that you just don't really hear out there very often.
And so during this time, obviously you have, your time is being consumed by this growing animal essentially. And I'm assuming, some level of overhead starts to tick up. And so during this process, as far as your profitability, is what's keeping the lights on here? Is it just the origination points up front and the investors during this time before the fund, they were just earning their simple interest, or were they also sharing in some of the origination points? How did your structure look?
So we took the points. That was our compensation for the deal flow, the marketing, the underwriting and due diligence, and the packaging up that for our clients. We passed through a majority of the interest, and so another way that private fund managers or trustee brokers like myself create revenue is through an interest spread as well. So if we were lending out at 12% in second position, we would pass through, 10 and a half. Early on, we passed through even more, but generally we'll keep a spread of 1 to 2 points on the top of that and creates a recurring source of revenue for us.
Got it. So, just for simple math, if you told the flipper who came to you, who wants a loan that, hey, it's riskier, second position, it's going to be 14%. Let's say you were paying the investors 12%, you would keep that 2% spread on the difference plus the origination points. So you had the
Correct.
upfront, keeping the lights on, and then you had that residual reoccurring simple interest from that spread as well. Okay. So that makes sense, because I'm sitting here and I'm thinking to myself, like, how do you keep the lights on? Because I've seen this broken down so many ways. And at the end of the day, I'm like, man, what makes this profitable? Like, how do you make this a profitable and growing business? What was the tipping point that eventually pushed you to move into a fund model? And then can you just quickly talk about the difference between, because what you've been saying so far is you've been finding lender partners. So people that have, capital, they're coming in as a partner. You guys are placing a loan, but now you've just transitioned to a fund. And what's the difference between that and this new model of the fund?
Well, a fund is really essentially creating that entity structure and pooling all of the capital into one single source. It gives us more autonomy to be able to lend, and it gives us more ease and streamlined lending practices, right? I don't have to go and money match make. And if I find a really great deal for $500,000, I don't have to go dial for dollars anymore. I think the impetus for that, though, and we had talked about it for quite some time, we had really reached the capacity constraints where it was much more difficult for us to be able to find deals, or find capital, I should say, to fund the deals that we needed. Once we were lending it out, because we had a fair amount of volume, then I would have to go and private money match make in the background saying, hey, Tim, I have this great deal. It's 250. I know you say you only have 200. Can you scrape another 50 together? And that takes a lot of resources. So at any point in time, we had, maybe 3 to 7 staff, which I think for the amount of volume that we had was quite high because it was such a high touch business for us. And we felt that really when the book published in 2022, that was a natural progression for us to really make that leap, create the debt fund that we knew that we needed to get to maintain our level of originations and continue to grow on that. And with the exposure of the book, I knew I was going to be getting some more hard or cold leads coming in saying that they wanted to lend out with us. And so it really seemed like the appropriate time. But I know that there was a lot of financial acumen and strategy and operational expertise that I was missing by moving over into a debt fund model. So my husband and I really thought carefully about that and decided that we needed to partner with somebody who was really well seasoned in that space. And so we started with one. It didn't really work out very well. She was too inexperienced. But then we went to a seasoned hedge fund manager who was really looking for to get back into that space, but didn't want to deal in equities and Wall Street and the overwhelming day-to-day and pressures that go with that. And so we blended our expertise in real estate with his expertise in managing a fund. And so that's what allowed us to move over into this model very seamlessly.
And so with the fund, it's essentially just a big pool of capital that you can lend out on behalf of everybody who invests their money into that pool, right?
That's right.
Yeah. And so do you have to be accredited to invest in that fund?
In ours, you do. There are some flavors that would require you not to be accredited, but our particular fund does require you to.
And then let's say that we place capital. Let's say, hey, Beth, I want to put some money in your fund. What does that look like? How much? What's the minimum amount for investors to bring to that fund? And then how long is that tying my capital up?
The minimum investment is $50,000, and we have what's called a lockup period. So that's how long your capital needs to stay in the fund before you can request to remove it, or what's called a redemption. And our redemption period is 12 months. So meaning we'd like you to keep your capital in there for a minimum of 12 months. Now we make concessions, right? We have just guidelines in our private placement memorandum that outline our standard business practices. But should we have that liquidity, then we can always make exceptions to be able to grant some of that back. But the lockup period really is in place to ensure that we don't have a run on the fund, just like a bank, right? We all know Silicon Valley and First, those, that was fairly recent, right? And so I think that resonates with us. This is the exact same practice that we employ in a fund, is that we just don't want to create a run on it. So we have these gates. So after 12 months, you can request or redeem, but we have the ability to provide that capital back in installments up to 4 quarters. But generally speaking, we can give it back if it's smaller amounts.
And to run this fund, you just mentioned you have somebody who handles the securities, like that former hedge fund manager. What are, I guess, organizationally, who did you have to put in place to make the fund run?
So many people. I mean, it's such a different, more complex business model than just managing trust deed private placement, right? So me trying to find a loan for you requires much less resources, because when I return that capital to you, it's returned to you. I'm not having to continually pay you. But when I have your money in my fund, I have to give you, a preferred return monthly regardless. And so if I'm not actively deploying all the capital within my fund, that's creating what's called a cash drag. And so I needed a seasoned fund manager. I needed a fund administrator. So that's a third party accountant. The administrator goes and does all of our month end. It does our quarter end. It produces our quarterly statements for our distributions. They handle all of our accounting and could potentially handle our audit for us if we were ever to need to do so. So fund administration is absolutely imperative as well. I have a securities law firm that I employ, not only to help me set it up, but to help make sure that I'm doing everything above board. So they're always my first call and line of defense when I have any questions about what I can and cannot do. And so then I also have a bookkeeper. I mean, there's just so many different resources on the back end. On the front end, for the borrower side, everything is still very seamless, and nothing has really changed except that you see our fund, the Lend to Live debt fund, as the lender of record now, not just an individual.
So when I invest in this fund, you're investing my money for me. You mentioned cash drag. What happens when you get into this position of cash drag? I guess you just need to be confident enough that you have enough deal flow in the local market through your typical borrowers that you can support the fund and not have a cash drag scenario, right?
Yeah. I mean, I just think that a lot of people, there's so much out there that talk about how to set up your own fund, how to set up your own syndication. They don't really talk about what do you do actually after you set it up and place capital into it, right? And so, yeah, you really do need to make sure that you have this really steady deal flow on the borrower side before you begin setting up a fund. Because again, with the whole trust deed placement, if I've got 5 capital investors that have, $250,000 or $100K sitting on the side, there's no consequence to me as the broker, right? They may want to place it into a money market account that's high interest bearing, which fortunately we have as a circumstance right now. But a couple years ago, where would you place that, right? Especially even a private debt fund. If you had hundreds of thousands of dollars sitting there, where are you going to put that in the interim until you find another deal to fund?
So that's a strategy where you could put capital into like a money market that is high yielding in the interim if you have a cash track. Okay. So question about deal placement is like back in the day before the fund, if you found a deal and you underwrote that deal, were you then taking that to the investor and saying, the lender, the money partner, and saying, hey, here's the deal, here's what we've underwritten. Do you want to participate in this? Yes or no? Is that how it used to work before the fund?
Yeah, we never wanted to cattle call our loans. I really worked very hard on an onboarding process that made sure that any investor that was considering being a passive investor and placing their capital with us truly understood not only the investment vehicle and strategy itself, but understood how to work with Flynn Family Lending and what that looked like, that entire process from us sourcing the deal to presenting it to them, getting docs back, reviewing them, giving them the authorization to approve and review them, when they would wire their funds. We did all of that at the beginning because, as you know, dealing with a private lender who's not very well versed in it can lead to some attrition and it can lead to some churn. The last thing I want is a private lender walking away from the funding table because they just got scared at the last minute and needed some extra time when time is absolutely of the essence for the borrower. And so that onboarding process was very important to understand what their issues were or questions, help answer those, and then to be able to also give them some recently funded deals to share some feedback with me on, I liked this deal, I wouldn't have taken this one. I liked this one, but I have questions or I want to lower the loan amount. And that allowed me to really, truly understand what their deal criteria and preferences were, as well as what their risk tolerance was as well. Because I have to back into each and every individual capital partner's needs, wants, and goals, right? And so at your stage of life and with your risk tolerance, you might be willing to take on second liens or higher loan to values for a much higher return. But I have some that are, again, retired boomers, liquidating their real estate portfolio, lending their capital out for a passive source of income and liquidating their real estate for estate planning purposes. But they just want a safe and secure place to lend it. Otherwise, they would have kept it in the stock market, right? And so I really need to understand each individual's preferences.
So let's say that I invested in your fund. What does it look like? Like, how is it monetized? What kind of returns, I guess, are people looking for when they invest in the fund? And then how do you keep the lights on with the fund? How are you monetizing from, the Flynn family standpoint?
Sure. So I had to structure this fund in somewhat of a unique way in that I was bringing over all of my existing clients. Again, remember, I had about 40 to 50 million under management in whole notes. And they were used to doing business with Flynn Family a certain way. So when I opened up the Lend to Live private debt fund and said, hey, everybody, I'm going to migrate you over when your capital comes back, they had a lot of questions, and so I had to structure it so that they had very comparable returns, the same level of transparency and involvement that they had before. And so we structured it with what would be called a 7.5 preferred return. That means that of all the interest income that we take into the fund, right out of the gate, 7.5% is set aside for our LPs, our fund participants. Then we take management fees and expenses out of that. So we have a 1.5% management fee. And then any other expenses, whether that's legal, fund administration, bookkeeping, that comes out. And then anything that's left over, that profit gets split 70-30, 70% to the fund participants and 30% to the managers. So I really needed to make sure that I was hitting a target return anywhere between 10 and 11% annualized, because that's what they were used to getting. And I actually thought that it might be easier just migrating over my existing capital, right? Like I have this captive audience who's been working with us for 5 to 10 years, rather than trying to your point, raise capital from net new cold leads. But actually, I realized that there was a lot more hoops to jump through with my existing capital base because they were used to, some really great returns, high levels of autonomy and transparency, obviously, because they were named on the legal instruments themselves. And so there was a lot of work to migrate them over. But the fund structure really is in their favor, for sure.
So you have to be lending this money out at a sufficient enough interest rate that they're making 12%. And then, the management side is 1.5. That 1.5 is what's paying for the overhead of the fund and the company. And anything above that goes back to Flynn, which, I guess would be company profit. And so really you need to be mindful of the interest rates that you're lending this cash out to keep the lights on, keep investors paid. Are you worried at all about the interest rate environment declining on the private money side? Because, if they are expecting this level of return, that could be detrimental, right?
Right. And great question. I mean, if you were a hard money debt fund, you absolutely would be concerned about that. Again, my line of business is such that we have creative financing solutions that no other lender can provide. So even in an up market, people need seconds. People have rental properties that they want to cross collateralize, loans that they can't get out of or don't want to refinance out of just to get bridge debt, right? And so even in a down economy, I would say the same thing. It's even more paramount. I have a rental with, 150,000 of trapped equity into it. I have a 4% conventional 30-year fixed loan. I don't want to rewrite that just to be able to acquire new rentals. So Flynn Family will always have its place. We're a perennial favorite because everyone is always going to be needing some form of creative financing at some point in time. That allows us to keep our rates pretty steady. We're always between 12 and 14% on seconds. And so our average borrower note rate on our debt fund is around 13.5% right now. And that allows us, again, to try to hit some targeted return of 10 to 11. That's not a guarantee. None of it's a guarantee, but we try our hardest to make sure that we do so. And as the first year started, when you know that your expense ratios are quite high when your fund is just building up, I actually gave back all of our management fees and much of our management return to keep that level up there at the beginning for our early adopters who came into the fund. We don't have a need for that anymore, but I think our annualized return at the end of last year for 2023 was just under, I think it actually was around 11. Don't quote me on that. My fund manager has those exact numbers.
As far as like the company profitability, you have overhead, you have employees, you have legal fees. So that's coming out of the management fee and the spread that doesn't go back to the investors. Then you have your overhead costs. You personally, are you earning income from a distribution from the company quarterly or annually? Are you just taking distributions? Do you pay yourself a salary? How are you personally generating income? Because you're outlining this company that's just taking on a life of its own. It's growing. You have, employees. I was looking at your website. You have a number of employees, interns. How are you personally getting paid?
Up until 2 years ago, when we got this office space, we still operated in our basement, even when we had employees. And so I will say that private lending is one of those few businesses where you really can get started and launched with very little overhead and very little capital out of pocket, really, if you do it right. Because we had a couple of investors that lent their money through us. And so my husband and I just had a small amount of our own to invest out. But we do have overhead now. We have staff. We have two different companies, really. We have Flynn Family Lending, and then we have the debt fund side of things, and that's the Lend to Live management company. And for our fund manager to hold them accountable and to be really impacted by our profitability, we gave up a small equity share for him to come on board so that he would partner with us. I didn't want him to just be, a staff member. I wanted him to be very much a key constituent and very embedded in the company itself and benefiting from the profitability of it as well. So we have staff that gets paid out. But again, we have points that help cover our overhead on the borrower side of things. And then our interest returns help cover the fund manager and the management side. My husband and I take a small salary, and then occasionally we do distributions, but I like to keep a lot of it back in the company itself too.
Do you have to keep reserves when you have a fund in a company like this? You have so many investors, so much money. Do you have to maintain a reserve account?
Well, I do. I've always, as a best practice, kept, 6 months reserves for our, monthly expenses on the Flynn family side of things. There are not that much in the way of expenses, as I mentioned, on the fund side. And so we don't keep any reserves there because you're obviously not creating a whole lot of interest income when you keep a significant amount of reserves. And fortunately, of the near 50 loans that we have in the portfolio right now on the fund side, since we still have a large amount that are still in individual host trust deeds, but all of ours are performing. Our default rate is excruciatingly low. When you operate very conservatively, like we do with 65 to 70% combined loan to values, there's too much equity for most borrowers to really want to walk away from.
Yeah, that makes a lot of sense. So the investors are getting about 12%, 10 to 12 depending, which leaves about 2% for you guys operationally to keep the lights on between, I guess, the spread, right? Plus you're making the origination points. So the origination points plus about 2% on the spread of the placed capital to keep operations moving in the company. Is that accurate?
So our points are anywhere from like 1.5 to 3 or 4 points. That goes to actually Flynn family lending. And then the interest income comes to lend to live. And so we keep our expenses separated on both sides of the house.
Okay, that makes sense. So like the employees who are underwriting the loans and communicating, gathering docs, the legal, those are on origination points. And then the interest spread goes to the company of the lend to live company. And then that's where you guys get paid a salary. And then every once in a while, a distribution gets paid out of there. And I'm breaking this down because, I'm looking at you as a mentor and I'm like, okay, well, how could I build something similar like this for myself in the future? I'm trying to deconstruct it and understand it. I know we're coming up on time and I want to respect your time. So I have a couple questions for you as we get out of here. Number one, who was your first hire? Because I know it reached a point where you're like, holy cow, I need help. Who was that person that was your first hire to come in and help you, and what did they do?
We hired a marketing and sales consultant. It was actually, a friend within my network who had worked in the franchisees business. And so we thought, well, what a perfect fit, actually. He could provide us with some sales and marketing support since we didn't know what the hell we were doing when we first started. And he had that for small business owners like ourselves. So he could help. But it really just started with a little bit of everything, right? You can't just find one person that can only just do sales. My husband took in all the sales calls. I did all the operations and the funding. And so we need someone that could help support some of those activities. So he would help put together our term sheets. He would help collect the documents, and then I would underwrite them. So really acted more of a loan processing type of role, and did a little bit of sales and marketing for us on the side too.
That makes so much sense if he came from a conventional mortgage side. He's doing those upfront sales calls, setting the expectations, right, and you're helping on the backside. What is it? What does the process look like right now? Who do you have for employees? And then what does this loan process look like? You have an underwriter, you have, somebody who's like processing and gathering documents. I saw on your website, no third-party appraisals, meaning you guys are comping the properties in-house. Can you just give me just a overview of like who supports Flynn Family Lending? So
we have a loan analyst, and he helps take in all the loan applications, collect all the loan documents, send out term sheets and whatnot. I have a business manager who helps do some of the business stuff for me in the back end, but she also does all of our loan coordination. So once the terms are approved and all the documents are collected, she will help make sure that it funnels through underwriting, which is me, and she does a little light underwriting as well. She then ships it off to our attorney who prepares the documents and reviews them, and she does all of the title and escrow coordination as well. I recently hired a sales director, Nee Lee, who came from a hard money lender as well, and he's also an investor, and so he helps with a lot of our inside sales and pre-qualifications. And then on the lend to live side, I have a fund manager, as I mentioned, that's a business partner. We actually, in his entity, we have partnered with not only a fund manager, seasoned hedge fund manager, but a legal partner as well. So he provides us with legal support. And then it's Matt and I. So I have a couple of interns. And at any point in time, we've had a handful of loan officers. But as the market started slowing down a little bit a year or two ago, we really felt like we wanted to back into the lower transactional volume and lean into the great reputation that we had in the region as a company. We don't need really any loan originators, so to speak. We just needed to continue getting the good word out there through social media and let them come into to me and my team so for processing.
Beth, you're like a psychological blanket for me. I'm glad I have your phone number because I saw that you do some coaching, and I'm probably gonna hit you up in the future because I just have so many more questions. But I know we'll wrap up with this. That's impressive how lean it is and how you guys have grown the team. What's the future look like? What do you see that's changing on the horizon as far as, impacts from technology, just the private lending space as a whole? What are you looking at forecasting that, you're kind of, starting to maybe not, prepare for a storm, but, loosely make plans for in the event of?
Well, this whole book published with Bigger Pockets really sort of opened up the doors for me. I'm really grateful for the opportunity that my co-author gave to me to participate in this and share a lot of the, 8 years of experience that I've had. And so we're looking to expand that ever so slightly. We've started delving outside of Washington and providing some creative financing with investors that we know and like on deals that look super solid. The key concern that I've always had with expansion is that can I still provide the same great level of experience for my borrowers and my investors, my passive investors, the same way I have as a small company, a small team locally? And do I have the ability to create the same team in market elsewhere? Because I need an attorney in that market. I need great title and escrow. And so I really want to make sure that we take on deals very slowly and purposefully so that we don't get ahead of ourselves. But then, on the horizon, once we have this fund fully funded, then there's a possibility of being able to create a second fund and continue on this line of work in other markets and expand out. But I'm not really too concerned about that. The landscape is changing in the industry, but I kind of tend to stay myopically focused on what we're doing because this is a lifestyle business at the end of the day. My husband and I really want to make sure that we have time for each other and our kids and not let it grow so much so that it's taking even more of my time and energy because it already is like a really big full-time job for me. And prior to this, I spent 8 years doing tech consulting part-time. So it was a much different pace now than it was for me 10, 15 years ago.
Well, I will leave you with two questions, and then maybe I can convince you to you and your husband meet me for dinner out in Las Vegas at some point if we're ever, or in Washington if we're ever in the same place at the same time. So I'd love to follow up with you in the future, but I'm going to leave you with two questions here. The first is, are you still taking your revenue, your active income, and investing in passive cash flowing assets? Are you still buying real estate to this day for yourself to hold?
I am. I actually just closed on a triplex in the Tri-Cities area in Eastern Washington. It's just a smaller deal, but generally annually we've placed some of our capital and our revenue into income producing properties so that we could have a deferral of tax, a tax deferral. That was a nice way to be able to push it out. So we've have a small number of small commercial multifamilies that we invest in, but generally I much prefer to keep my money out there making passive income through private lending instead. I just needed to have a tax deferral vehicle as well.
Totally. Plus you get the depreciation and the appreciation benefits. So yeah, I like it. Okay. Last question for you, Beth. In the intro of the podcast, I mentioned a quote by the famous David Geffen, and he says that we are each the figment of our own imagination, and some of us have a greater ability to imagine than others. And I'm just curious, who are you? Who's Beth in your imagination in the future or right now? Who are you? Who are you becoming that is inside your imagination?
We've had a little bit of a touchy subject for this middle-aged woman. For the last year and a half, I've gone through some existential crises, so to speak. I'm approaching 50, believe it or not. My husband's 10 years older than me.
Watch the video. I'm telling you, she looks like she's in her 30s. I'm telling you guys.
Well, thank you. Well, I'm feeling it. I'm living it. I'm really doing a contemplation every single day about who I am. Sometimes it feels cliche to say I'm a mom, but I really resonate more with my personal endeavors and my familial responsibilities than I do with my professional life. And so even though I can say I'm a published author and a small business owner, I really could care less about that. So I'm really trying to figure out what what identity means. Is it your values? Is it what you do? Is it what you are interested in or passionate about? I'm not really sure how to answer that, to be honest with you. But what I can say is that I'm just someone that is a lifelong learner, and I'm constantly trying. I may not know always who I am, and I might be battling imposter syndrome on a daily basis and my own personal insecurities about whether or not I measure up, either with my kids, my family, my staff, my community around me. But I'm still trying, and I'm still learning, discovering more about myself, and just trying to make sure that I'm the best version of me and adapting to it, because it's changing every single day for sure. I'm not the same person I was 10 years ago.
Well, that's the beautiful thing about this journey is we're not supposed to be, right? Just like butterflies, they were once caterpillars. We're supposed to change, and we go through this metamorphosis. But I will tell you this, Beth, looking from the outside, you are an absolute inspiration to a person like me who's looking at you as this, shining light, this beacon of, hey, this is how I want to navigate. This is where I'm pointing my ship. I'm using you as an unofficial mentor. I'm reading your book. I'm watching what you're doing, and just your journey is inspirational to those who are following behind you. And I just can't thank you enough for what you're doing, the trailblazing that you're doing and the work that you're doing. And so whatever turmoil or I guess, curiosity that you're at the point in your life, I can tell you from an outward perspective that you really have set a wonderful example for the rest of us to follow. And I'm just really grateful for your leadership and your mentorship.
Well, thank you. I appreciate your kind words and your support. And all of that is validation for me headed down the right path of being able to provide this kind of support and guidance for others that are on the same path, and making sure that they hold true to their why also, and overcome the hurdles that I've experienced too in my journey.
Well, Beth, thank you so much. And it has been an absolute pleasure I held you here longer than I normally do, but I just wanted more information, and we could have kept this going, but thank you so much for joining. Where can people find you? Where can people get a hold of you, follow you on social media, your website? Let's hear it all.
Well, I'm on Facebook, Beth Pinkley Johnson. I also have a Facebook group exclusively for private money lenders, whether that's passive or small active private lending business. And it's called Lend to Live. So lend to the number 2, live, semicolon, a private lender collaborative. And it's spam free. It's not a marketplace, so you won't have borrowers there. It's truly for educational and connect and networking purposes. I'm on Instagram at lendtolive.beth. Lend number 2, live.beth. I'm on LinkedIn as well as Beth Pinkley Johnson. And you can find me and Tim having dinner with my husband, Matt, in Vegas sometime soon, and playing pickleball on our backcourt.
I love it. The pickleball challenge is on.
Game on. Let's do it.
Beth, thank you so much. I hope everybody listening got value out of this week's episode. We will see you all next week. Catch you on the flip side.